Get your free copy of the complete tutorial at www.teachucomp.com/free.
Depreciation is the reduction of value of a fixed asset. It represents a reasonable loss of value caused by exhaustion, wear and tear, and the passage of time. Depreciation decreases the value of the company's fixed assets. It is then recorded as an expense for each fiscal period. This is the method by which the cost of the fixed asset is expensed over time. Remember that when you purchase a fixed asset, you do not record the expense at the time of purchase. Instead, the expense is taken over a period of time as the asset loses its value. Therefore, depreciation applies only to fixed assets, not items bought as expense items. It is also the reason that depreciation is sometimes referred to as a contra asset or negative asset. The concept behind depreciation is that it is assumed that fixed assets have a useful life, or a depreciable life, over which they are used up or worn out until they are worth nothing more than their salvage value. Therefore, instead of placing the expense of the purchase entirely in a single fiscal period, it is spread out over the life of the asset. The amount of value lost is recorded each period and is called depreciation. The total amount of value lost over the life of the asset is referred to as the accumulated depreciation. By depreciating an asset, the owner gets the tax benefits of the cost of the asset over a longer period instead of all at once. For example, if you purchase a $5,000 piece of equipment that will last you 5 years, you may deduct $1,000 each year for each of the 5 years as depreciation expense. While you may create individual fixed asset accounts for large assets like vehicles, some fixed asset accounts may group many assets together, like office furniture. However, if you are accounting for the value of multiple fixed assets in one account, you should keep a separate supporting list of exactly what items were purchased and the purchase price. The total value of all items purchased and attributed to that account in the asset list should exactly equal the amount shown for the account on your balance sheet. You should work with your accountant to set up your depreciation schedules. You may receive 2 different schedules, one for the book depreciation and one for the tax depreciation, as the amounts shown may be different. This is to satisfy the accounting and tax codes. In recording the depreciation into your books, you will use the amounts calculated by the book depreciation. Give your accountant information on all of the items to depreciate. This may include the name of the asset, its make or model, the serial number, when you bought it, and for how much it was purchased. Your accountant will return to you a depreciation schedule, which will be updated each year. Some computer programs do include a depreciation calculator that can allow you to calculate the depreciation on assets. However, especially for tax purposes, work with your accountant or tax preparer to get this information correct, or at least have them double check your figures. To find out what the estimated value of an asset is at any point in time, you need to know the asset's original purchase price and the accumulated depreciation that has occurred on that asset. If you take the original cost of the asset and subtract the accumulated depreciation, you will see what is called the book value of the asset. There are also a few acceptable methods of depreciation that can be used. Some can only be used with certain types of fixed assets. 2 of the depreciation methods we will examine are the straight-line depreciation method and the double declining balance method. Let's begin the discussion with the simplest and most basic type of depreciation, the straight-line method. In the straight-line depreciation method, you attribute an equal amount of depreciation expense to each year in the useful life of the asset. Before you can use this method, you will need to know 3 facts about the asset. First, you will need to know the original cost of the asset. Second, you will need to know the estimated salvage value of the asset. And third, you will need to know the estimated useful life of the asset. Since we already know what the original cost of the asset is, let's examine the other 2 concepts, the estimated salvage value and the useful life. When an asset is no longer of use to the company, it must be disposed. However, the value of the asset cannot be known for sure. Therefore, the amount that the company expects to receive for the asset when the asset is removed from use is called the estimated salvage value, and this is also sometimes referred to as the scrap value or residual value. In addition, the useful life of the asset is also impossible to predict. Therefore, the life of the asset is also estimated. Depreciation can then occur over the estimated useful life of the asset. You will want to consult your accountant to find out what the salvage value and useful life of your assets are. Note that the reason that it is also very important to keep a good record of your assets is that the numbers given for the salvage value and useful life of an asset can change depending on the type of asset it is. For example, office furniture has a different useful life expectancy than vehicles do. Now, once you have the three pieces of information about your asset that you need, you can then create a depreciation schedule for the asset using the straight line method. The first part of this method is to determine the total depreciable value of the asset. You can calculate this value by subtracting the estimated salvage value from the original cost of the asset. This will give you the total amount of depreciation to spread over the useful life of the asset. Next, you calculate the amount of depreciation to record for each fiscal year by dividing the total depreciable value of the asset by the estimated useful life. This will then give you the amount of depreciation expense to record for each fiscal year. You can also divide this annual depreciable amount by 12 to calculate the amount of depreciation to record for each month, which may be necessary if calculating depreciation expense for only part of a year using the straight line method. Unlike the straight line method of depreciation, which attributes the same amount of depreciation to each year over the useful life of an asset, there are additional methods of calculating depreciation which attribute more depreciation in the early years of asset ownership. Many assets depreciate in value more in the early years of their useful life, and these methods try to reflect this more accurately than the straight line method. These methods are generally referred to as modified accelerated cost recovery systems, or MACRs. The most commonly used accelerated depreciation method is the double declining balance method, although there are others. To calculate a declining balance method of depreciation, you multiply the book value of the asset at the end of each fiscal period by a constant depreciation rate. In the double declining balance method, the constant is 2, which is twice the straight line rate. However, you must still calculate the straight line rate in order to multiply it by a constant. In the declining balance method, you first take the total estimated depreciation amount, expressed as a percentage, and then divide that by the number of years of estimated useful life. To calculate the depreciation amount as a percentage, take the original cost and subtract the estimated salvage value. Then divide that by the original cost and multiply the result times 100. So for example, if we had a $20,000 asset that had 0 estimated salvage value, to figure out the depreciation amount as a percentage, you can see that we would take 20,000 and subtract 0, and then divide that by 20,000 and multiply times 100. Or, as you could probably figure out on your own, it's 100%. You can then take that amount and divide it by the useful life. So if we take 100%, which is the amount of depreciation expressed as a percentage, and then divide that by 5, assuming 5 years of useful life, that would give us 20%. This is the straight line amount expressed as a percentage. To then find the double declining balance rate, you would multiply that result by 2, which is the constant. This would give you a double declining balance rate of 40%. You then take the beginning book value of the asset for the year and multiply that by the calculated rate to find the amount of depreciation expense to record for the year. For example, if the asset had a beginning book value of $20,000 for the first year, you would multiply that by the 40% figure that was calculated. That would give you $8,000 in depreciation to record for the first year. You would then subtract that from the beginning balance to arrive at the ending book value for the first year of $12,000. That figure is then used as the year 2 beginning balance. You continue to depreciate in this manner until the final year of the useful life. Note that in the final year, you will not depreciate the asset below its salvage value.
Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.